All right, in this lesson, we are going to go over Sarbanes Oxley Act. We're going to give you a broad overview. We're not going to go into detail about Sarbanes Oxley because you just need to know the fundamentals of the Sarbanes Oxley Act. So let's talk a little bit about it. So here are some basics. It was a set of laws that was enacted in 2002 to strengthen the corporate reporting activities in the United States. Now, the reason why this was enacted was primarily due to financial statement fraud. So you remember in the first lesson we talked about the different types of fraud. Well, in the 2000s, the early 2000s, we saw a lot of financial statement fraud. Cooking the books, maneuvering the books, making them look just a little bit better. And that kind of caught up in the industry as far as fraud was concerned. And because of that, people lost a lot of money because they saw the decreases in the stock value because they were propped up by these fake financial statements. And so this act was put into place to try to bring about a little bit of confidence, investor confidence back into the financial capital markets. Now, this act was one step in restoring investors' confidence in the financial statement companies, in the financial statements that the companies were issuing. And so what it did was it brought about some new rules and some new things that had to occur in order for financial statements to actually be released and published. So what actually changed? Well, here are some of the things that changed. First of all, there were stiffer fines and prison time for those involved in these white-collar crimes. They weren't as strenuous because if someone steals money versus someone kills someone else, obviously you would expect that the person who kills someone else has a longer life sentence than someone who causes a white collar crime. And so it just didn't add up. So there was more stiffer penalties and fines and prison times that was attached to the Sarbanes-Oxley Act. Internal control evaluations. So there were a greater emphasis in evaluating the internal controls of a company. And we said that internal controls are basically what a company puts in place to help protect its assets and improve efficiency within its organization. So they are like rules. Example might be the key to your home. The lock on your home door is the internal control. You must have the key to be able to access the home, okay? The third thing that changed, kind of the broad overview of changes, is the independent audit committee. So every company has an audit committee. It's usually made up of the board of directors. This required companies to have an independent audit committee, which means that people that were on the audit committee cannot be also employees of the company. They must come from outside. And so it kind of solidified that role on audit committees having independent members so that they can act independently of what the company is doing. It also increased whistleblower protection and also included tip lines and codes of ethics to again strengthen the confidence in these financial statements. So those are some of the things that change for accountants. This also meant changes in how audits were conducted. So the way that it works is accountants prepare audits. They audit a financial statement of a company. So a company produces the financial statement. They give it to the auditors. The auditors then audit those. Auditors are usually external. So they are a different company that comes in and audit the company's books. So for auditors, which are also accountants, it changed the way that they did audits to ensure that we could rely on the financial statement numbers and the financial statement as a whole. So what changed? Well, it required a partner rotation over the engagement every 5 years. So typically the way that an audit works is you would have a partner. The partner would be the person in charge of the audit of the financial statements. They would sign off on those audited financial statements. Well, that partner must change every 5 years. Why? So that that audit partner doesn't get too comfortable with the company that they're auditing. If that partner has been auditing the company for 20 years, they have good relationships, good rapport of the executives at the other company, and that collusion can happen. And if collusion can happen, corruption can happen. If corruption can happen, financial statement fraud can happen. So the U.S. government has said that the partner must rotate every 5 years to hopefully avoid some of that close relationship with the auditor and the company. Another thing that changed, issuing reports on the effectiveness of internal controls. So typically in the old days, it was the auditors would come in, audit the financial statements, and they were done. Now companies needed, now auditors have to come in and not only evaluate the financial statements, but also evaluate the internal controls. Are they working effectively? Does the company have appropriate internal controls? Are people following the internal controls? Does it make sense that they have these internal controls and that they're helping to keep the financial statements appropriate? So that's what is required now of auditors. They have to evaluate the internal controls as well as the financial statements. It also established what the accounting and audit industry didn't want to do. It establishes the Public Company Accounting Oversight Board. What that means is there's now a governmental agency that looks over public audits. Public audits would be companies that are publicly traded on a national stock exchange. Those companies are audited by auditors, and those auditors are subject to the authority of the PCAOB. Before then, the audit and the accounting industry was self-regulated, so auditors regulated each other, and there was some good measures in place to make sure that the industry self-regulated itself. But because of the investors' confidence, the U.S. government put together the PCAOB to then regulate the audit industry. So that was something that the accountants didn't want to do, but that happened because of Sarbanes-Oxley Act. So that is an overview of the Sarbanes-Oxley Act. I know it wasn't a lot, but the basics was it changed the way that accounting was done, primarily due to financial statement fraud that was happening in the early 2000s. So because of that happening, the investors' confidence in the financial statements that companies were issuing was low because they didn't know if there was actual wrong numbers in the financial statements to prop up the numbers. These changes hopefully increase investors' confidence in the financial statements, which they have. So it basically helped reduce investors not rely on those financial statements. Now they can rely on it because of these measures that were taken by the U.S. government. So that is a look at the Sarbanes-Oxley Act. Hope you enjoyed this lesson. We'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.